Good afternoon and good morning. It's Ted Bader here with SI Wealth. Thank you all for joining us on our weekly webinar series today on June 3rd. Today we're going to talk about obviously the charts, kind of what the markets are showing, what the charts are saying. I did want to highlight that this weekly webinar, live weekly webinar, is going to be switched over to every other week. So we're going to go over on to June 17th is our next live webinar. We're going to try and put out some more commentary or a pre-recorded webinar in the interim. Try to figure it out. We've got a lot of very good feedback on this type of response, but it might not be live going forward. It might be kind of an email that goes out with a link or a YouTube channel update. So be aware of that when those come out. We'll let you guys know. Bit of housekeeping. If there's any questions that come about, please write the question out and we will answer them at the end through the Q&A. And I'm going to briefly talk a bit about what we've spoken about for the last couple months, tactical asset allocation. As you can see from the chart here, I kept it short and sweet. I just wanted to highlight this chart. We've been talking for the last couple months about where SIA fits into an advisor's portfolio. A lot of positions, a lot of advisors create buy and hold portfolios. They'll hold it through different market declines. And as it's seen so far in 2020, if you've held, it's bounced back quickly. What we're trying to say is use a tactical asset allocator like SIA, partly because of what we don't know. As you can see, going back to 2000, if you're an S&P TSX Composite Index investor from 2000 to the bottom, March 23rd, that's been flat. Now, you don't want to be the person that buys at the top, but I'm sure they're always worth people. Now, within interspace with that, the last 20 years, there's been an incredible lot of market movement from a Canadian perspective, especially in the first half of the decade, followed by a bit more cyclicality for the second half. Now, what we're trying to say is we can't pick the top or the bottom at all times, but when you have an asset allocation strategy like SIA, what we're trying to do is avoid those big pitfalls. Now, 2020 is a good example. We did not get out of the top, but we also got out relatively soon before it hit the bottom. You've seen this bounce back because of the unprecedented stimulus that the Federal Reserve and central banks around the world implemented, and the bounce back has been severe. What we're trying to say, though, going forward, we don't know if they have the same level of gunpowder or ammunition at hand. And what we're trying to say is if you have a tactical sleeve that has that ability to get out of equities or to overweight or focus on different asset classes, that's really where it comes in handy. And I think that's where the value out of SIA comes into. So this chart is quite telling from a Canadian point of view. This is why you want to purchase outside of Canada. This is why you want to focus on different asset classes, because depending on the time frame you buy, it's very difficult to try and time these things. And what you're looking for is some sort of an indicator, and this is exactly what SIA brings. So I know if you go to the next slide, I know we've kind of highlighted this and talked about it, but the fund lineup we have with BMO is really geared towards doing what the SIA technology strength is. So split between the 5 different funds, and we have those focused Canadian and focused North American funds, as well as that broad global equity, a broad balanced fund, and as well our global bond, our fixed income fund. All of these are trying to create different strategies. They won't always do what a lot of other traditional managers might be doing. But over the last 3 to 5 years, we've shown that they have consistently managed to stay at the top of their class and be amongst one of the top funds and compared very favorably to their peers. And that's exactly what you're looking for in a strategy. So I'm not going to talk much more about it. We've talked about positioning. I just wanted to highlight the tactical sleeve and some of the fund lineups as being a real benefit to an overall portfolio. And without further ado, I'm going to pass it over to Jeremy to give us our market outlook.
Thanks, Ted, and thanks everyone for taking time to join our webinar today. Just in conjunction to what Ted said about going every second week, certainly the market has not been as chaotic as it was in February, March, and April, and parts of May. So we are going to lighten that up, but bear in mind that we will do updates if necessary. So if something material happens, we will pop up a webinar. We will do a recording. I'll be doing the annotation of those charts and providing them out. And by all means, reach out to us at any time. So in the market update today, we're going to start with the equity action call. No change from last week. Green zone. So we're at our full equity positions within our mandates, and that's our objective, is to be at those. We can look back historically. I just highlighted back in 2009, 2012, 2016, the previous green zones. So there still seems to be some concern by some of our clients out there, whether they should be engaging in this market, given some of the unrest socially, politically, economically that's out there, and waiting to see what COVID's going to do. That seems to be a riskier play than being in the market, and that's why we're very tactical in what we do. We'll move out, but we generally see here that there are extended periods of time of green and yellow. So the volatility is going to be there from time to time, but we've seen lengths with that, and again, would expect some strength going forward right through the fall. Looking at our asset class rankings, there's been no changes from last week. International equity remains in the first position, cash in the second, U.S. equity in the third, currency in fourth, which is just short-term money market and currencies not U.S. and Canada. And then Canadian equity remains in fifth place, with commodities in sixth. And finally, bonds, fixed income remains at the bottom of our list here. So there's no changes. Cash is stubbornly sticking in the second position. We have seen the indicators be very relatively close within these. So the expectation is there could be some changes in here if the markets continue doing what they're doing. We'll wait and see them before we act, and we would advise you to do as well. But again, sitting on the sidelines may not be the best decision, and maybe legging into some of the SIA wealth management funds through BMO would be a good solution if you're unsure on where to go. I used this chart last week. Debt and reallocation continues to drive the markets higher. That message has not changed. We still have global monetary and fiscal measures to the tune of trillions of dollars are still being pumped into the system. So there has not been a let up of that. We're not quite getting the daily updates, at least in Canada, of additional spending coming out, but we know that a lot of that spending is in the pipeline and is coming into the system. There is really no incentive near term for governments to control debt. They've seen interest rates fall, so they have the opportunity to increase debt without dramatically or if at all increasing the debt servicing load on taxpayers. So I think that's more of a bar that they've been using. So again, there's lots of powder left in there. I've heard numbers as high as 400 billion plus that Canada can do based on the lower interest rate and maintain its debt servicing pre-COVID. So there's still lots of powder in for the guns of economic stimulus for the governments in Canada and around the world. And then again, rotation of bonds sitting in the seventh asset class, and I've got a chart on real estate coming up here a little bit later. They continue to be areas of rotation out of it. Clearly, there's significant supply on the bond side coming out, both on the corporate side, junk side, and now in big government bond issuings, which is increasing supply. So, that's not expected to drop anytime soon. So that's an area where money managers are potentially rotating out of fixed income into equities, and then real estate, where you have significant businesses announcing that they may not return to office space. And we, like all businesses, are evaluating as well how we can be more efficient and have employees work from home to reduce our expenses and exposure to commercial real estate. That's obviously going to continue to put pressure on real estate, both on a residential basis, with a tremendous amount of Canadians having to defer their mortgages during this crisis. And equities, it seems like a logical solution place to go. So the pros, again, I use this chart, but I've got a couple new slides on here. The stock market is still fired up about these economic openings across the world, as we see economies put employees back to work, get back to buying and selling for businesses for the first time in months. Vaccines are still on everyone's lips, potential bullish activity there. Pent-up demand for goods and services. We see spending rise at the top right corner here. We can see a chart based on consumer spending through Chase Consumer Cards. The source is JP Morgan, but we can see that in the latter part of March, early part of April, spending bottomed out and has been starting to increase. So that trend is in place. What I found interesting about it in this chart is that the spending is very, very similar, whether there was never an order to isolate, whether the order was lifted, or whether it's still in place. The spending seems to be rising at a similar level. And then finally, new COVID-19 cases continue to move down. The trend is down. There is a little increase. I had this chart in our webinar last week. We can see that it increased, and now it's rotating over, but the trend is still down, coming from the end of March, early April, just as that spending increases. So again, there's some bullish opportunities for the stock market. The charts today, I'm gonna talk a bit more about some specific areas in the market, but I'm going to spend a minute on one of our top level indicators, the SIACharts Market Equal Weight Index versus the SIA Cash Equal Weight Index. So equities continue to be dominating cash. We can see by the trend, the green arrow is showing that equities are outperforming cash, and we can see that that ended really back in 2017. We've had a consolidation sideways, and then in 2020, our large drop, but since the latter part of April, we've seen that equities have been performing very well versus cash, and we're participating in that. So we're not quite up to the levels where we were in February as far as the relationship, but still remains very strong on a short-term basis. The SMAX is positive, and we can see that intermediate-term trend is in place. What is really, I think, interesting about it is that, about this chart, is that we've also seen some erosion in equities, and this was largely hidden by the ETF surge in purchases where only a few stocks were participating, and we can see that breadth decline moving from 2016 right up into 2020. So maybe one of the rotations that we're going to see is away from just those mega caps and into the broader market, as potentially some of the domestic firms take advantage of some of the unrest politically and trade wars that we're seeing globally around the world. Going to highlight a number of sectors now. So from the SIA sector report, we've got SIA Computer Software Equal Weight Index, and it's quite telling how strong this rally's been, and being in the right sector is very, very important. Computer software has surged very well. We can see that the chart has taken out the February highs that we saw in 2020. So certainly an area where there's been tremendous opportunity since the green zone has come back into place. This really highlights the drive for businesses moving online. If you look at the names that are underlying or those companies that have been prospering online, and we're already there and having great success with it. So the chart remains, as you can see, on a very, very long pull upwards. A correction here would not be out of the question. Certainly, we wouldn't be wanting anyone to sit 100% cash, get some exposure to the SIA BMO products in your portfolios, but a pullback here would be an opportunity to engage as well, and wouldn't be out of line in the context of what we're seeing in a green equity action call. Leisure is another area that is doing very well. It's ranked number 2 within the SIA sector report. It's got a very strong chart, hasn't hit highs as we saw with consumer software. But what I think is quite telling about this is that the leaders within the sector are names like Eldorado Resorts, Planet Fitness, and Royal Caribbean. So you're seeing these real out-in-person businesses starting to see some success, starting to bounce off grossly oversold levels, and I think really highlights that pent-up demand potential that's, as people come out of their homes and start engaging in the market. Again, slightly overbought on this chart here. A pullback is not out of the question, but a sector to really keep an eye on as we go forward. The next chart is the SIA Electronics and Semiconductor Equal Weight Index. This is ranked number 3, hitting at key resistance, so right up against its January and February highs of 2020. So a potential breakout here. So that resistance is there, and we see that again. We've had a heck of a rally here, but we don't want to be entirely on the sidelines with the market and the green equity action call. So this is highlighting the drive for businesses with smart technologies are having tremendous success. And also we're seeing potentially some of the names that are in here, an expected resurgence in electronic sales. So again, one of the sectors, if you're looking to engage, this is where we're looking as well. Drugs, we've talked about it, shouldn't come as a huge surprise, sitting in the number 6 position on the SIA sector report. Again, another chart that has reached new highs above its February levels. And we can see that on this chart, it's been consolidating for some time since 2018, and even you can go back to 2015, where it was near the levels where it broke up above 58,000 there. But we've now achieved that. So drugs, obviously, favoring businesses that are going to prosper during a pandemic situation with potential vaccines or treatments for COVID-19. And then, of course, I think it would be naive to believe that there won't be a strong surge and a strong interest from investors for those companies that are going to seek out solutions for future pandemics as well. So great opportunities in this sector as well. So some other bullish sectors as of June 2nd, 2020, we've got health services, again, falling in line with that drugs, metals and mining, really participating in that materials move, precious metals and materials. So we've seen gold be a strong position in the commodity side. Internet, again, relying very similar to computer software on the sales and everything there. But also, I think, interestingly, is automotive. So to see that coming up back up there and sales of vehicles and motorized vehicles are doing very well. So we're seeing these are the areas of strength. This is where we're focusing our attention largely in our SIA portfolios. On the other side of the spectrum, going to the negative sectors that are within the SIA sector report, banking is sitting in the last position, 31 in there. So it is moving up. You can look at the chart on a short-term basis, has moved to an S max of 8, which looks good, but we can see this is quite a dramatically different chart than what we've seen from those top sectors. More volatility in it, less real upward drive than we've seen. The risk reward remains weak. There is upside potential here, but again, I think sector, we're seeing that rotation. Banking was weak largely going into the COVID crisis, but has only weakened during it. This is highlighting potential problems with consumer debt, bad loans, and potential growth in banking in a post-COVID-19 world. So again, a sector that we're not participating in to any degree. Transportation, certainly seen as a bellwether of stock market success. So, kind of going contradictory to what we're seeing a green equity action call. But we do see that it has a short-term S max of 8, sitting 28th in the SIA sector report, just hasn't bounced back, but again, highlighting the continued problems in airlines. Certainly a lot of articles that I've been reading suggest that the airlines are going to be reducing their planes and obviously have some significant changes to do as far as seat positionings and really reevaluating their business models as a whole. So there's going to be a lot of changes there. Travel companies and commercial transportation really just have not kicked back in, but we're in the early stages of the opening economically, so we'll watch this one. But again, not something to be jumping at in the near term. And I think one of the more important ones is real estate, and especially for a Canadian investor, because real estate has grown to be the most influential sector within our country, largely based on a very, very strong residential market and a very, very strong commercial market in the major centers of Vancouver and Toronto. So those fortunes seem to have been reduced dramatically through COVID. Once a leader now potentially seeing problems as businesses maybe fail. Certainly one of my favorite restaurants shut down the other day. So sad to see them go, and maybe it's going to be a world of franchises that can absorb these big breaks that'll be there going forward. And then with the work to home and tougher consumer mortgage rules, the banks, even though interest rates have dropped, the amount of loans have been reduced for many potential buyers of houses. So real estate continues to be another area that struggles. So some other bearish sectors, we're avoiding. Retail is right at the top of the red zone in the 17th position. Construction, so I think relates largely to what we've seen in that real estate market. Energy, again, been an extremely volatile sector, but lots of overhead when it comes to potential political and environmental moves doing that. Consumer non-durables, insurance, aerospace and defense, which probably seeing it lower than it is right now gives us some optimism for where the market is predicting some of this social unrest is at, and potentially problems overseas. Seeing it in the negatives, maybe not a bad thing, but this was a sector that was sitting at the top of the list for a very, very long time pre-COVID and seems to drop. And then media really highlighting, again, that transition from traditional media sources to online sources such as Netflix, really sitting there. So with that, I mean, really the drive today was to give you some examples of sectors and areas to go where we're focusing during this green zone as we get forward. Really still see upside potential in the market. Technically, nothing is at least blinking to the yellow or the red zone at this time. So positioning in there, and as Ted mentioned, that tactical positions are so important in your portfolio going forward. So with that, I think we'll open the floor for questions. Ted, do you have any questions out there?
Yep. Yeah, we have a couple questions, and I remind everyone, if you do have a question, just type it out in the question tab, and we'll get to it. First one is about the asset class ranking, and it's a question, I guess the bonds are still in last place. I guess the traditional thought is that bonds are a good choice in volatile markets, but we're seeing it as last place. So is this something different this time?
Yeah, and I think it rang more of 2008 than it did of other downturns that we've seen previously, where fixed income was really under tremendous pressure. Certainly there was situations where bonds were being priced very, very negatively, even high quality products during the initial downturn of this. So you have that overhead on it. And I think it's largely just a rotation. The amount of debt that is going to be financed by governments, by businesses over the next little while as they've combated the COVID, just too much supply. I mean, supply and demand is really at play here, where there's too much supply of bonds and there's not enough demand. So we're seeing that rotation. I think bonds and real estate are two areas, and I've had an opportunity to talk to some institutional global players who are talking about their clients changing their allocations, reducing their bond exposure, increasing equities, as well as reducing their real estate exposure and increasing equities, looking for strategies that can provide similar rates of return. So again, it is a little bit different this time. We would have expected during a conventional downturn for bonds to perform a lot better than they did, but it really highlights how that tactical nature of money management is going to be much more important going forward.
Okay, another question that ties into the asset class ranking is still, and I think you answered it partially, but cash at number 2 and U.S. equities at number 3. That's been that way for about a month, even though U.S. equities have done better. So how close are they to each other, I guess, is the question.
Yeah, a great question. They're extremely close in the rankings. It's almost day to day that we look for that to potentially change. We do not move in advance of it, because we've seen this many times where things tie each other and get very close and then reverse. I'm not saying that that's what we're seeing, but cash is just so much money on the sidelines is held there. It is leaking into the system, but certainly it remains in place. So, we would expect continued strength in U.S. equities would help it out. The U.S. market has been dominated by fewer names maybe than international, where it's maybe a little bit broader based rally than the U.S. market, certainly with the NASDAQ stocks dragging indexes quite a bit higher and them contributing to the S&P 500. So there's a number of factors at play, but it does look so far that it's very close, and we could see a transition at any time.
That ties into our next question. Can you comment on the differences between equity price and the earnings, for example, on the S&P 500? And I guess it's kind of are valuations getting a bit overblown at this point, from your opinion?
Well, we're not a traditional fundamental shop because, PE ratios have such a enormous spread. There's certainly valuations are higher, I think, in many of the mega caps, and I think I was alluding to that. One of the nice things that we've seen continue to develop is that some of those small and mid caps are seeing better performance than the mega caps. So we're seeing things like the Russell 2000 perform better than the major indexes. So I think that's probably where the value is, and we're seeing some of that rotation in the marketplace. So I think that's an area where exploration would be if you're concerned about valuations. But again, we've seen valuations get stretched and held stretched for long periods of time. And when you take in the implications of the tremendous amount of fiscal and monetary stimulus that's in the system, you can think back to 2008, 2011, 2016, where that stimulus came into play and really powered the market into new highs. So I think it would be risky to rely just on PEs at this time.
Okay. Another question. I think this, I'll loop Paul Vendrinsky in. Some of the gold positions in our Focus North America have significantly detracted from returns for the last few days. Is this a concern? I don't know.
We might have Paul on here. Well, I'll talk to it broad-based. I'm not the PM of the portfolio, so can't speak directly to those positions. But yeah, I can talk to you from observations. Technically, we have seen pullbacks in the precious metal stocks. Their relative strength has not deteriorated enough. And again, we see an overbought nature on a short-term basis with many of those sectors. I didn't highlight precious metals. I'm just going to scroll down in here. But metals and mining continues to rank extremely high. It's a 7S max and obviously precious metals in there. So on a short-term basis, obviously not excited by it, but has not moved to a position where we see that rotation coming out of play.
Yeah, I think it ties into a number of the charts you showed. And you mentioned that there could be a risk of a short-term correction. If in those situations, then gold will obviously be a nice hedge to have in a portfolio. So yes, it could hurt when everything else is going up, but it could also help when things might be going down. So yeah, so that's the answer to that. If there's anything else, please feel free to reach out to anyone on the SIA team. We're more than happy to help. But if it's, we wish you everyone the best of luck with everything, and we will reconnect with a live webinar on the 17th. In the meantime, we'll get out some commentary. We are pushing out our monthly commentary. So for the end of May, it's going to be ready probably this week, and by the end of this week or early next week, you should be getting it. So we'll have all the commentary in there. So thanks everyone, and I'll leave it to Jeremy to sign off.
Yeah, thanks again, everyone. Again, we'll continue to monitor the market, and we appreciate your loyalty coming into the webinars. We've had great turnout. We want that to continue. We're here to update, and we will move to interim updates if necessary, if the markets dictate out there. So thanks again. Have yourself a great week.